Liberation Day is here, which means the Trump administration is now slapping on tariffs on multiple countries that are importing their goods into the United States, which is going to shake up markets and it's going to shake up the global economy. But I don't want to talk about this from a political perspective. Instead, I want to talk about this from a financial perspective. More specifically, what is this going to mean for the finances of the United States government? Because the White House is considering a 20% blanket tariff on most imports into the United States. What's going to actually happen, we don't know. There's a good chance that things are going to be changing a lot over the next week. But when it comes to dollars, the White House says that the United States is expected to raise $600 billion to $700 billion a year from tariffs alone. But not everybody agrees. The Moody's chief economist says, quote, if you get $100 billion to $200 billion from tariffs, you'll be pretty lucky. So how much are we going to generate? It's going to depend on what the actual tariffs are, but somewhere between 100 billion on the low end to 700 billion on the high end in additional tariff revenue. But how much does that actually play a factor into our economy? Well, let's take a look at the numbers. In 2024, the IRS collected $4.9 trillion in tax revenue, out of which $77 billion in 2024 was tariff revenue. So if the United States government collects $700 billion in tariff revenue, which is on the high end, that would be 10x what was collected in 2024. But the real concern and the real thing that people are paying attention to is not just how much money we're generating in taxes, it's also how much money we're spending. Because for the last number of decades, the United States government has been spending a deficit, meaning they have been spending more money than what they generate from taxes. In 2024, the United States government collected $4.9 trillion in taxes, but then they spent an additional $1.9 trillion in deficit spending, which means the government collected $4.9 trillion, they spent all $4.9 trillion, and then they spent an additional $1.9 trillion after that. The reason why that matters is all of this deficit spending has to be money coming from somewhere. And in the government's case, this money has to be borrowed. Where do they borrow this money? They borrow this money from regular people, investors like you and me, if you go out and lend money to the government by buying a treasury. They borrow this money from foreign governments like China and Japan. And then they work to borrow this money from the Federal Reserve Bank, who is a big lender to the United States government. But this is where now that whole process gets a little bit more confusing, because the Federal Reserve Bank doesn't have the ability to just lend money to the government. They're not sitting on any cash reserves, even though they're called the Federal Reserve Bank. They have to print that money. So when the Federal Reserve Bank then prints that money, and then they give it to the United States government in the form of a loan, more money gets created out of thin air. And when you start creating more of these paper dollars, the value of each individual dollar goes down, causing the prices of things to go up. This is what inflation is. So this deficit spending is a big driver of inflation. And if you've been keeping up with any of the financial news or you've been reading market briefs, you know that inflation has not gone away. In fact, the most recent inflation report said that inflation came in even hotter than expected. It triggered a big downturn in the stock market. Market Briefs, for those of you who don't know, is my free financial newsletter where every day my team is working to break down what's happening in things like the economy, the stock market, the housing market, the crypto market, and the global economy into a fun and witty and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every day, and it's completely free. So if you haven't joined Market Briefs yet, I have the link for you to join down in the description below. But here we have this problem where the United States government keeps spending more and more and more money, and now the Trump administration says that we're going to work to generate more tax dollars in the form of tariffs. But that's just one side of the picture, because tariffs are a tax, and it's paid for by the businesses that are working to import the product. So if I'm Ford or I'm GM and I'm importing car parts and I have to pay 20 or 25% in tariffs, well, I have to pay more money to bring that part in. And generally, if I'm a business and I have to pay more money to get my product, I can do two things. I can either eat up that higher cost and have a smaller profit margin, or I can pass that cost down to my customers. Normally, a business would pass the cost down to their customers, but we're also seeing a lot of inflationary issues. We're seeing credit card debt rising. We're seeing delinquencies rise on debts, mortgage debts, and a lot of other types of debts. So for consumers to continue paying more money would also create more economic pain. This is what's creating a little bit of a dilemma. This is where the Federal Reserve Bank says we could see, quote, transitory inflation due to the tariffs, because it might cause the prices of things to go up if businesses have to pay more money. But if you look at it from the government perspective, tariffs are one way to drive a little bit more tax revenue. But the question then becomes, what is the government going to do after that? Because remember, it's how much money do you generate from taxes and how much money do you spend? The government is looking to generate more dollars from tariffs, while they're also looking to generate less dollars potentially from income taxes, because we know that the United States government is now in the process of passing one of the biggest and largest tax cut bills in the history of at least many of our lifetimes. What's going to actually be passed, we'll keep an eye on that, but that would mean that less people would be paying less amounts of money in taxes. Does that mean necessarily that the government's going to collect less money in taxes? Well, maybe, but not necessarily. There's also a chance that lower taxes will cause the economy to grow, which could mean that more people are generating more dollars and thus paying more dollars in taxes, but we'll see what ultimately happens. That's a goal. We'll see if that actually happens. So the government's trying to pass the tax cuts while raising tariffs, but we also have to keep an eye on spending, because this is one thing that ultimately will make or break the deficit spending problem that we have. The United States government has been running a deficit for decades now. And it doesn't look like we're getting out of this deficit just yet. Yes, we also have DOGE, which is looking to reduce some government waste, and we're seeing the United States government cut departments, lay off people to cut spending. But the ultimate question will be, how much spending can we cut? And what is the impact of that in the economy? Which then takes it one layer deeper. The economy runs on spending. When you spend $1 at Chipotle, you are stimulating the economy. When you go out and you buy the extra guac at Chipotle, you are stimulating the economy even more. And when you go and you finance your extra guac at Chipotle with your Visa or MasterCard, you are really stimulating the economy even more. The economy loves you so much when you are spending money you don't have, because now not only are you making Chipotle rich, you're making them richer because you're buying the extra guac, but then you're also making MasterCard rich because you're financing it. So you're making a lot of people rich, just not yourself. And that's good for the economy, not so good for you. Well, the largest spender in our economy is not you, me, or Jeff Bezos. It's the United States government. And so when the United States government spends money, they might be hiring people to work in the government. They might be writing contracts for contractors. All of these things stimulate the economy. But now you can start to see the double-edged sword. On one hand, the government is spending all this money to stimulate the economy because they have all these departments. They can be bloated, they can be fat, they can be unproductive. But on the other side, all that money spending is also creating inflation. So you have unproductive workers on one hand, which is waste, which is also stimulating the economy, because that means somebody has the ability to pay their mortgage and buy their car. But then on the flip side, that also creates inflation. So on one hand, spending, even if it's unproductive, it's good for the economy. On the other hand, it hurts inflation. And this is that dilemma. If the United States government cuts spending, that's going to hurt the economy. And how much economic pain are people going to be willing to go through to actually reduce inflation? Because in order to actually bring inflation down and to actually get inflation under control, you have to pull some money out of the system. That means there has to be some economic pain. And that can be a very difficult thing to say or really believe, because a lot of times we want no economic pain, economic growth, and lower inflation. Well, when you've had all the money printing that we've seen happen, when you've had all the economic growth that we've seen happen, it's not very practical to do that. And that's the dilemma that the United States government is facing. So now we have the whole concern of what's going on with tariffs. And yes, tariffs are going to shake up markets. It's going to create a lot of confusion. It's going to create a lot of headlines. We'll be covering all of it in market briefs. And it's be creating a lot of controversy. But I want you to understand what this means more from a financial perspective. That way you can find the opportunity. Because while all these things are happening, what Wall Street is doing is they're asking one question and one question only. Where is the money moving? And what we are realizing is that there's a lot of different places that money is moving because of things like tariffs. There are people that are working to buy more gold, for example. Gold prices have been breaking new record highs because investors are concerned of what's going to happen in the economy. They're concerned about inflation. They're concerned about a lot of different things. There's been investors and Wall Street bankers that have been working to invest money in different places, different countries, to invest in different ports because they believe that trade is going to shift around the world. This is the way that I want you to think. I don't want you to think in terms of fear or panic or politics. I want you to think in terms of opportunity. And the reason why that's so difficult is because it requires you to stop thinking like what everybody else does. Everybody says Republican, Democrat, and all these different things, which at the end of the day is not going to put any money in your bank account. I want you to look at it from a reality perspective. I want you to look at it from an opportunity perspective. Now, that can be hard because that means you got to put aside the emotion, especially when you go on Instagram or Facebook and everybody's posting some sort of angry or emotional comment. Well, none of those things really help you eat or buy a trip to Disney World or go wherever you want to go. I want you to think in terms of opportunity. And that requires you to now put aside the emotion, get your money right. Have money to put aside. That way you are not spending all of your money. So you have money to save, you have money to invest. Now, when you get out of the paycheck to paycheck cycle, you have a little bit of breathing room because you finally have some money. Now, when you have some money, you got to decide how are you going to invest this money. Are you going to be more of a passive investor, investing your money into the S&P 500? Or are you going to be more of an active investor looking for individual opportunities that are more risky but more potential return? Again, I can't tell you what to do. I'm just a random guy on YouTube. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But we have a lot of changes happening. And as an investor, what you want to look for is where is the money moving? And when you hear the news that tariffs are going to be coming and tariffs are going to be changing things, a lot of money is going to be shifting hands. And if you can start to study that and start to pay attention to that, well, now you'll start to see opportunity instead of seeing problems and complaints. And whether you like them or you don't like them, at the end of the day, your job is to figure out how you can build wealth from what's happening. That way you can take better care of yourself, you can take better care of your family, and you can take better care of your community. And with that, I will see you on YouTube tomorrow.